Hey, this is Sasha, and welcome to another episode of Let's Talk Stocks, episode number 173. And today what I'd like to do is give you some insights on some news and things that are going on in the marketplace. For example, the Spotify IPO. We'll talk a little bit about Jerome Powell there with the Federal Interest Reserve interest rate hikes that they're talking about, and the meetings on the Senate and discussions that they're having. And we'll also discuss a little bit about the Trump's taxes and tariffs that he's implying on some of the companies. So in either case, with that being said, let's take a look overall here at a couple of news and announcements. First off, remember, we only have a couple days remaining on our course that we just released this month in the passive investing section. So it's the passive dividend investing course. If you go to the Rise to Learn website right there, we even have a video up right now that shows you sample footage directly from the course. So this course is on sale right now. It is packed with a lot of modules, 14 modules over 12 hours long. There's one day left, so Friday midnight, basically Saturday, early morning. The sale will end, and then you'll end up paying higher prices. So in either case, with that being said, be sure to take a look at the course if you're interested in learning how to invest in high-paying dividend stocks, or for the long haul to making money through dividend investments. Next thing I want to cover is taking a look at Spotify IPO. Spotify files some paperwork in order to go through the IPO process. And more than likely, it'll be an IPO or initial public offering. It'll be on the stock market soon. Now, this IPO, if you're wondering, well, do I need to get in it? Should I get in it? Should I buy it? You know, a lot of people stress over about, hey, trying to get in and be the first one in. The reality is it's a little difficult to get into an IPO right away. That's the first thing. The second thing is you may not want to get into the IPO right away. And I'll share with you a couple of instances, like let's take a look at the Twitter IPO. Right when Twitter first came out, yes, you did have some of that initial buzz where the stock went from about $40 a share to about $60, $70 a share. But after that, that stock tumbled, right? So again, not a big deal that you don't have to get in it the first day. Same thing here with Facebook. Even though that stock here opened up around $30 a share, you know, it went sideways for about a good year until it really started to ramp up and pick up steam. If you look at Square, the same thing. Had an IPO, you know, you go in about half a year later, still went sideways, and then finally it broke out and moved higher. So again, looking at an IPO, it'll create an opportunity for you. Doesn't mean you have to be the first one in. So just keep your eyes peeled for the IPO as it gets released. See where the chart patterns evolve, see if there's momentum. But the first couple of weeks, I wouldn't bother touching it. You're not going to miss a lot if you're looking for the long haul. Also, the big news here, of course, is Powell hints at some rate hikes. He talks about 4 rate hikes this year. Some people say 3, some people say 2, some people say 5. Who knows? You really don't know. That's the thing. The long and the short of it, you don't know how many rate hikes they're really going to have. They're estimating 4. Probably they'll get 3 in there, maybe 2. But you really don't know. The market doesn't like rate hikes simply because, well, now the cost, it slows down the economy, right? The cost of borrowing starts to increase. So more rate hikes means people can't go and get loans because there's people that are right at the cusp of buying a house, and that extra few $100s in interest payments, now they can't afford it, right? So this is ultimately what happens. Car loans, the same thing. So now instead of paying, let's say $250 a month for your car that you ended up getting a loan on, now you might pay $275 or $290, and some people just can't afford it, and that also means they may not get approved for that loan. So this is what really happens with rate hikes, but they need to hike rates to pay off the debt. So this is the concern with America right now, is that, you know, America is in such big debt. I mean, imagine you living in debt your whole life, right? So your whole life you're in debt. You're always in debt. You're not worried about paying it back. That's what America does. Most Americans, they live in debt. Credit card debt is just the way that things happen here in the United States. It's the mentality, borrow money, borrow money, borrow money. And it doesn't really matter up until the point that it does matter. And oftentimes when you have to start repaying things back to your debt holders, like China holds our debt, and many other countries, they hold this debt, these bonds, they're kind of like our creditors, right? And we have to pay them back. Now, if we don't raise interest rates, that means it takes us a lot longer to pay those things back. So there's a lot of other problems that go along with this. It just slows down the whole process for them to pay back their debt. But this is really where the concern lies, is because not only does it slow down the regular person and their economy, or the way that they deal business on the day-to-day world, but also for the government. And the government needs to, at one point, start paying back those debts or paying back what they've borrowed. So that really creates a problem. And even China recently talked about, hey, we're not going to be buying any more debt, meaning we're not going to be giving any more loans to the United States. Instead, we're going to be just slowing down our purchasing. And they didn't want to say, hey, we actually want to get rid of all this debt. We'll sell it to somebody else. Because, right, so if you default on a loan, a car, a boat, usually that person will off-sell that debt for 70 cents on the dollar. Meaning, if you owed $7,000, some other company will buy it for, let's say, $5,000, and they'll try to collect from you, right? So they make a little bit of money from that. And this is what really China's trying to do, is saying, hey, we're trying to unload our debt. We don't want to buy any more U.S. debt because the U.S. is horrible at paying people back. And they just continue to climb in debt. So what happens is they just say, hey, we don't want to buy more of it, but they also don't want to say, hey, we want to get rid of it, because if they say we want to get rid of it, well, that also will tank the coupons that they're holding, the debt that they're holding, because that means they're trying to offload it. So anyways, this is really what's happening. The market gets scared of these things. It also slows down companies in the stock market, because their cost of borrowing now increases as well. So that's one of the things why stocks slide. But they also slide because you get Trump trying to say, hey, we're going to tax and put tariffs on steel and aluminum coming next week. I mean, that's like saying, we're going to start taxing anything that starts coming in our way, which, it does help to some degree the debt problem. But on the other hand, the problem that you have is the cost of goods will just increase, because these get passed down to the consumer. So let's say bananas start getting taxed. Well, instead of 59, 69, 79 cents a pound, you now might start paying $1.29, because all the supplier is going to do, or the person that has the bananas, well, they'll just raise the rate a little bit to pay for these taxes. And that's really what ultimately usually happens. Now, the other problem here, why the market gets a little more panicky, is also because, well, what happens if now other countries start taxing us? So the stuff that we actually make, which is not a lot of stuff, because America is more of imports a lot of things. They don't export as many things. But all the things that we get, whether that's from China and other things, they start becoming more expensive. So your cable that you start getting, whether the cable that you use for your charging phone, instead of a $5 thing at Walgreens or Walmart, it might be a $50 thing. Probably won't go up that high, but you go from $5 to $12 or $15, and you slowly start increasing this by 10%, 15%. And if all your goods start increasing by 10, 15%, that starts becoming expensive for the regular average person. So anyways, these are some of the issues and problems that you want to be careful of as you start looking at the overall markets. And this is why you have a lot of people that are talking about there's a lot of underlying risks in the markets. Now, I've talked about this for quite a while, that the market overall has been stretched. And when you really look at it, I mean, it has been stretched. But the market is short-sighted. It's not going to see things in the future that much. They only talk about things right now, today. So you had this massive sell-off right here, which we had in February. Let's bring it back a little bit. You had this sell-off right here. You had this counter trend bounce where everything's good now again. But look, we're breaking this upward supporting trend line again. So this upward trending support line is breaking. Volume is picking up. I don't think we're all of a sudden just going to go higher. I believe we'll come back to retest this 2600 level, give or take, or somewhere around 2650. I mean, already we're picking up steam on the sell-off as I look right now. So nothing says we can't come back to 2600 or even 2550. And if you really start getting in trouble, when you really start looking at this and saying, hey, well, we're in some massive trouble. I mean, with this tax cut that you're giving, between Trump policies, the crazy stuff that they're doing, and also the Federal Reserve raising the interest rates, I mean, there's nothing that says you can't come back to right here, 2000 level, right here, which is basically at the same point where Trump took office. Now, yes, the market did climb fairly high right there, But, you know, a pullback, 2,500, even 2,000, nothing says it can't happen. And then you might get a bounce at that point. But if you really get nasty and you get into a recession, pull back to 1,500 right there. Yeah, it can happen. I don't want to scare you, but it can happen. And that's when you get some catastrophic moves for multiple years. Multiple years you get problems. It could be 5 years. Just like over here. This sell-off took about a year, right? A year and a half. But for the regular person to get back to feeling more confident, it took about 4 or 5 years, minimum 4 or 5 years. Same thing here, 1 to 2 year sell-off. But again, to get back to the regular person feeling confident investing, 4 or 5 years. So here, a sell-off, 1 2 year sell-off, again, 5 6 7 years easily, right? So anyway, let's take a look at a few different stocks here in the marketplace and just show you why I'm also seeing this, where trouble could just be really around the corner. So let's start alphabetically. Apple, we talked about the 180 level trouble. It's basically a double top right here when you look at it. Coming into key resistance level, selling off. Here was another support, selling off right there. A bit of trouble right there. Looking at Amazon also coming in right there near the highs, near the highs. If it can't hold this 1,500, which right now it's 1,495, 1,400 level, 1,495, and we start rolling over right here, I mean, this can pull back easily to, well, 1,350, just like where it was. Now, that's just a normal pullback. What if this starts becoming a recession and a problem? You could sell off 300-400 points to the $1,000 level, even $900 level, no problem. So, you know, be mindful of where we're at. Caterpillar, you got the A to B, B to C, break right here, come back here. If we can't bounce here, you'll see this roll back over. And now you got the A to B, B to C, and you got the C to D, will put you right back to this $120 level where that stock was hitting some highs in the past. So gives you something to think about there. Here's Colgate-Palmolive. You look at this one. Here, actually, let's look at the weekly. When we look at this, you can see we have some resistance here overhead. You also see kind of this upward trend line, this being broken in volume on the bearish side, picking up in a big way. Trouble. McDonald's, here's another one, big one, right? Stock was climbing so well for a long period of time. A to B, B to C, could be C to D, could be in the 145 soon. You know, if we can't hold right here, 155, if we can't hold that level, nothing says you can't go down to 140. There's no rule against that. There's Microsoft, classic double top. Again, problems. Doesn't mean you can't get a bounce soon, just like we got a bounce over here. Real nice bounce. But I'm saying that, again, you're stretched very quickly. You became stretched again. Netflix, that 290 level needs to hold, but you got a little top problem at the 300, also a round number. Nike, same thing. When we look at this on the daily, you can see resistance, tried to get above it, couldn't hold it, and selling off. And if you look at the weekly, look at how that comes in almost right there from where the 2016s were. So just gives you a little perspective right there. PepsiCo actually. Here, upward trending support line. Holding. If this breaks, you got some problems, right? So be very careful. We're right at the tipping points, and if we get a little more fear and sell-off action, P&G right here under 80, you know, was over here 95, or what was it 90, 93, 94. So if we get, you know, a little more selling action, this can come into 70, and this market can roll over in an even bigger way. UPS right here. Look at this one. Also support, upward trending line right there, and volume picking up. And right here, if you look at this, you got some serious sell-off. And if this stock continues to roll over further, you know, you got some more major problems. And Walmart right here, look at Walmart here, look at the longer term. We've got this support line, this at $80. So if you look at the weekly, the daily, we had some trouble here, massive sell-off, right? A little bit of retracement coming in, 200-day right now, So looking at it on the weekly, coming down into the 80 may not be a bad thing. That might be where the support starts getting a little more favorable. So it'll create an opportunity, right? Because that stock was at 110 and it's coming into 88, may even get to 80. So think about it, like a 20% haircut or so, about 18% discount on Walmart if you're looking for the long haul. Otherwise, that stock hung out around the $50, $60 for quite a long period of time. And I'd say a nice sweet spot, maybe around 70. So if you really look at the whole average point of this, coming in from the 80s, you know, somewhere right around, well, 76, 75, 72, 78, around there might be an interesting purchase point. So anyways, those are some stocks for you, give you some take on the overall market. You know, you really don't know where the market will ever go, but you get an idea by looking at kind of the volume, the overall fear. If you get overall extensions to the upside like that, you always want to be cautious. And the same problem occurs is if you get some sell-offs that are a little bit more straight line without any kind of bounces, also concerned, because that's when people are just dumping things. So when you're trading markets like this that are more volatile, you always want to trade a little lighter, a little smaller, go a little wider if you're doing options, and be a little more careful, you know, slow things down. You don't need to trade fast and get in right away and get out right away, because it's going to whip around much more. So you got to give yourself more cushion, more pillow room, make it a little bit softer, you know, easier on the landing, because it whips around much faster when you have these more volatile conditions, especially if you're used to these conditions right here and now you're in these conditions. It's a big difference, world of difference. So and it just switched like a light switch like that. So be very careful with what you're doing. Trade lighter. If you've had losses, don't worry, move forward. There's many more years to live, hopefully. And, you know, just continue to work at your craft, your business, learn what you're doing and understand where you're making money, where you're losing money, and how this ultimately works. So anyways, thank you for joining me this week. I hope you really had a good week. You know, we took a little bit of time off, a family vacation there last week. So I hope you enjoyed that video that was pre-scheduled. And again, as a reminder, we do have that passive dividend investing course that you can get at risetololearn.com. It's under courses. If you want to go to the stock trading courses right there, you can scroll down. And then we have the passive dividend investing course right there. So it is on sale, on special. If you want to watch the video, there's some actual sample footage right there directly from the course. Take a look at that. And that way you can learn and understand how to invest in dividend stocks the right way. Anyway, thank you again for joining me. In the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. If you want to subscribe to the YouTube channel, hit the button right over here, but get on my newsletter list so that way you get notified when we have promotions, discounts, or other great training by clicking the link right over here. Join my trading family, and then I'll see you each week in the newsletter. All right, thanks, take care, and I'll see you next time.